Peter Lynch is the man who achieved a 29% average return per year over his investing time frame of 13 years. That is crazy, guys. He originally started with $20 million of assets under management, and at the end of his 13-year stint, he finished with $13 billion of assets. And after that, he retired because he was a very wealthy man. Now, it's a very fortunate thing for us investors that Peter Lynch left behind a trail of knowledge into how he managed to achieve this 29% return, which is even higher than Buffett's average return. People consider Buffett the greatest investor of all time. Peter Lynch got a higher investing return. What I wanted to do with this video, guys, was dig deeper and show you guys 9 rules used by Peter Lynch to achieve above average investing returns. Rule 1. If you study 10 companies, you'll find one for which the story is better than expected. If you study 50, you'll find 5. There are always pleasant surprises to be found in the stock market. And what Mr. Lynch is getting at with this rule is study, study, study as many stocks as you can, because it is the person who studies the most stocks, who turns over the most stocks, wins. Okay, I'll give you an example. Let's look at gold miners, okay? I want you to tell me, who do you think will mine more gold? The person who sits there sieving through gold for 2 hours a day, or the person who sits there sieving through gold for 10 hours a day? I mean, it's pretty simple. The person who did it the longest is the most likely to get the most gold. It's the same with studying stocks, guys. The person who studies the most stocks, looks at all the different opportunities, is the most likely to get the highest returns. And this is exactly what Lynch would do. He would just sit there and go through as many stocks as possible, just searching, sifting. It's what Sven Carlin does on the YouTube channel. He goes through a ton of stocks. We try to do it with this channel as well. And we just search for hints of gold. And obviously Peter Lynch, he found a whole lot of gold because his average return was 29% per year. Rule 2. Everyone has the brain power to make money in stocks. Not everyone has the stomach. If you are susceptible to selling everything in a panic, you ought to avoid stocks and stock mutual funds altogether. And yeah, unfortunately, some people should just not be buying stocks whatsoever, because investing is predominantly about a thing called temperaments. And I wanted to show you why it is so important to be able to keep calm when everyone else is panicking, and adopt this ability that we call temperament, or as Charlie Munger will call it, equanimity. Okay, so let me take you back to 2008, the financial crisis. This was the time when everyone was panicking, and obviously the world was going to hell, or as some people thought, most people thought. But the people who actually thought properly, looked at the facts and not their emotions, realized this was actually the cheapest time to buy stocks, because all the fundamentals were going for extremely cheap rates. And the people who looked at the facts, like Warren Buffett, Phil Town, Monish Pabrai, all of those great investors, started putting a whole lot of money towards stocks. They bought them when they were cheap, and obviously made a whole lot of money in the bull market that was to come, the 10-year bull market that is still going along, guys. And I'm sure if Peter Lynch hadn't retired, probably is on a boat right now, relaxing, drinking margaritas, but if he was still investing, he would have done the exact same thing. Reacted with the facts, not with his emotions, and bought stocks when everyone else was panicking. Rule 3. Your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries that you already understand. And this is something that Buffett does, and I've talked about it before. He only invests in companies that he understands. 30 years ago, he started buying the stock called Coca-Cola because it's an easy company to understand. He grew up drinking it as a child, and it's a basic business selling soft drinks. And he could calculate the value, and he realized it was cheap. Buffett, he owns companies like Kraft Heinz, the food company, Apple, the phone company, and a bunch of other basic businesses that he can understand. And that should be the same with you. If you're someone that's into gaming, look deeper into gaming stocks. If you're into food, look at food stocks, shopping, clothing, all of that. Choose a niche market that you understand, that you are passionate about. That's rule 3 for Peter Lynch. Rule 4, over the past 3 decades, the stock market has come to be dominated by a herd of professional investors. Contrary to popular belief, this makes it easier for the amateur investor. You can beat the market by ignoring the herd. Yes, Wall Street are what's known as herd investors. And it's easy to tell this because all you have to do is look at the ratings on a particular stock, the recommendations. When Facebook stock was doing poorly, Wall Street were recommending sell, sell, sell. And now that the stock has come up, and we've seen a bit of a bull run, they're all saying, yes, it's a buy, yes, it's a strong buy. What you'll notice with Wall Street, when you've been in the investing game for a long period like I have, is that they follow the herd. Or they are the herd in a way, because it's just that type of environment. It's all about short-term news. They're all packed into a tight environment, all following each other. And this doesn't work because let's just take a look at Facebook stock for an example. When was the right time to buy the stock? When it was cheap and it had gone down a lot in price? Or when everyone was saying buy, buy, buy and it was higher in price? Well, obviously when it was cheaper. And Wall Street do the exact opposite of what you should do logically. They buy when everyone else is bullish and they sell when everyone is bearish. And, where us individual investors come in, we have the advantage to not give in to what the herd is doing, and the advantage to look at the facts and the fundamentals of the stocks. This is how we win. Rule 5. With small companies, you're better off to wait until they turn a profit before you invest. In this rule, it all comes down to speculation. Unless you know an absolute ton about an industry, about the business that you're investing in, you are best to wait until the company that you own is actually making money, not burning through money, because then you're just speculating that they will one day turn a profit. You don't have reliable facts to back upon your investments upon, no reliable fundamentals. As the company is losing money, you're just hoping that one day it will gain money. Generally speaking, if you're investing in those small type speculatory businesses, you want them to be making money. Rule 6. If you invest $1,000 in a stock, all you can lose is $1,000. But you stand to gain $10,000 or even $50,000 over the time if you're patient. You need to find a few good stocks to make a lifetime of investing worthwhile. So there's a couple of important points that we can pull out from this rule. The first is risk and reward. Unless you're playing around with stock options, debt, and all of that, the maximum that you can lose with your investments is your initial investments, okay, the amount you put in. But the maximum amount that you have to gain is unlimited. Just imagine investing in companies like Apple, Amazon, Coca-Cola at an early stage. You would have made some ridiculous returns on your investments. So what you really want to do with investing is balance your risk and reward. Pick stocks with a whole lot of upside and a whole lot of low amounts of downside, guys. Okay, the next thing that was pointed out in this rule is you need to pick a few good stocks to make a lifetime of investing worthwhile. And Lynch is actually an advocate of not picking a ton of different stock picks, okay? He recommends only picking a few companies that you know well and then holding them for a long period of time. Rule 7. In every industry and every region, the observant amateur can find great growth companies long before the professionals have discovered them. Okay, I like this rule here because it speaks to the advantage that we have over professional investors. And you've got to realize that professional investors generally have a lot of pressure on them. They're in big teams. They've got to make money for their clients. So they're investing in pressure environments. And as an amateur or independent investor, we can just sit back, okay? We don't have to be in those environments. We can be at home, have a cup of coffee, and read over the different opportunities. There's no pressure on us. And that means we can think in a new and unique way. We can look at the world, look at businesses through a detached point of view, and thus it's a lot easier for us to find great growth companies. Rule 8, there is always something to worry about. Avoid weekend thinking and ignore the latest dire predictions of newscasters. Sell a stock because the company's fundamentals deteriorate, not because the sky is falling. Now there's a lot of investors, particularly Wall Street, and even a certain amount of YouTubers that are always going to panic at the slightest amounts of news on a stock, instead of looking at the fundamentals. J&J stock, investors panicked when recently they heard that asbestos might be in some of their products about 20 years ago, when massively down in price. Facebook, okay, people panicked over the spending of money on privacy and security ahead of short-term earnings. Wall Street, okay, this is what you need to know about Wall Street. They tend to focus on the short term. If you can get over the short-term thinking, start studying the fundamentals, you're going to be 3 steps ahead of everyone else. So avoid the weekend thinking and avoid the latest dire predictions of newscasters. I hate to say it, even Peter Schiff. It seems like every year it's like market crash coming, everyone panic, everyone, invest in gold and, I don't know, stay in bunkers underground. Like what Peter Lynch is saying, we need to avoid this type of behavior. He's saying stay calm, look at the facts, and you will do well. Rule 9, if you don't study any companies, you have the same chance of success buying stocks as you do in a poker game if you bet without looking at your cards. Okay, what he's getting at here is if you don't put in any work, your poor results will end up showing. Now this is one rule that I slightly disagree with Peter Lynch on, because the difference between investing and poker is that investing, the odds are always stacked in your favor, because when you invest in stocks, you own businesses, and over the long run, businesses will always make money. Whereas a poker game, the odds are stacked against you, they're in favor of the house. But anyway, what he's trying to get at with this rule is do your research, guys. Make sure you know what you're investing in. That way you are less likely to lose money. And Peter Lynch has achieved that 29% return by using this mindset outlined in these rules of investing. Trust me, if you can follow these 9 rules, you are going to be a lot more likely to beat the general investor. And maybe if you're ridiculously good and follow a similar mindset, you could achieve returns like Peter Lynch.